What happened in 2008? It's been over a decade since 2007-2009 financial crisis, but its effects are still vividly remembered by those who lost their homes and jobs back then. Several factors precipitated the crisis, the primary drivers being years of cheap credit and lax lending standards that fueled the housing bubble. However, a few years before the Great Recession, Americans faced tech bubbles burst and 9/11. To jumpstart the economy after those events and encourage consumer spending, Federal Reserve lowered federal fund rate from 6.5% in May 2000 to 1% in June 2003, which led to record growth in home prices as borrowers, including those with low or no credit history, were taking advantage of low mortgage rates. Meanwhile, after the dot-com crash, Nasdaq dropped over 70%, resulting in a loss of billions of dollars. Wall Street was eager to find a safe resource of return, and that's when mortgage-backed securities and collateralized debt obligations came into play. Investment banks would buy massive amount of mortgages from lenders, hold them together, and then sell shares of the pool to investors as mortgage-backed securities. As investors were getting rich, insurance companies wanted to cash in too and began to sell credit default swaps, an insurance policy that pays out if the borrower defaults on the loan. Soon enough, the amount of credit insured reached $62 trillion. As home prices skyrocketed and the housing market appeared strong, insurance companies were not concerned about risk. Meanwhile, because lenders were selling their loans on a secondary market, they had no incentives to avoid risk, and with high demand in their mortgages, it didn't take long for subprime loans to emerge. Subprime borrowers generally have low credit ratings and most likely to default on the loan. Soon after, those high-risk mortgages ended up in the bundle that were sold to investors as mortgage-backed securities. When borrowers defaulted, investors found themselves holding a worthless paper as investment banks flooded the market with foreclosed homes. In 2008, the housing prices started to free fall and the domino effect began. Investment banks stopped buying mortgages from lenders as insurance companies were faced with impossible payouts. Some of the largest banks that existed for centuries were wiped out, including lenders and insurance companies. The aftermath was horrific. Around 3.8 million Americans lost their homes to foreclosure. The unemployment rate reached 10%. The household net worth declined, wiping out over $19 trillion in wealth. Despite the financial institutions causing the disasters, they received generous bailout from the government and awarded themselves with hefty bonuses.